Net investment income tax. What is that? Hey taxpayers, it's Tiffany Gonzalez CPA here, founder and CEO of Accounting to Scale, and today we're back with another installment of What is That?, where we discuss financial term and topics you may have heard, but we make them super easy to understand. Today, we're talking about the net investment income tax, which is very important for high income earners who are investing into assets such as the stock market or real estate. So if that's you, tune in and let's get started right at the beginning. Net investment income tax. What is that? The net income investment tax, also known as NIIT, is a very tricky tax. A lot of people who invest in assets and earn high income forget about this tax or may not even know about it. At tax time, when I tell someone how much tax is due, I like to let them know how much of that tax is the NIIT tax. You see, everyone knows and thinks about the income tax. That is those graduated tax brackets, 10, 12, 22, 24, all the way up to 37%. But a lot of people forget that there is an additional 3.8% net income investment tax on investment earnings. So let's get into what is and what isn't net investment income. Net investment income is not wages, Social Security benefits, life insurance proceeds, or income you earned from a business. It is also not qualified withdrawals from your 401k, payouts from pensions or annuities. It is also not income from selling your primary home that is tax exempt. And it is also not tax exempt interest from municipal bonds. Net investment income is dividends, capital gains, interest, rental income, royalty income, and any other investments that you passively invest in. Now, if you have net investment income, it doesn't necessarily mean that you're subject to this tax. The next test is whether your modified adjusted gross income, basically your income, exceeds a certain threshold based on your filing status: single, married filing jointly, head of household. Right now, those thresholds are $200,000 for a single individual or $250,000 for a married filing jointly couple. So if your income exceeds the 200 or 250, depending on your filing status, and you have this net investment income, that is when you will start to be subject to this net investment income tax. So if you meet the requirement for net investment income tax, how much tax will you actually pay? The rate of tax is actually 3.8%. It's taxed on either the amount of income that you earn from this net investment activity or the amount of income you earned above the income threshold of 200,000 or 250. Whichever one of these is less is your net investment income tax. So let's get into two different examples in which someone would pay net investment income tax and how much they would pay. Example number one. Your net investment income is less than your modified adjusted gross income overage. So let's say you have $30,000 in net investment income. This could be income from dividends or interest or stock gains. And your modified adjusted gross income is over the threshold by $50,000, right? So for example, you're a single person and you made $250,000. Since the threshold is $200,000, you are $50,000 above that, right? You will now owe 3.8% in tax, but on what amount? Since $30,000 of net investment income tax is less than your modified adjusted gross income of $50,000 over the threshold, the 3.8% tax is due on the $30,000. You will pay a net investment income tax of $1,140. Now, let's do example number two. You still have the same $30,000 of net investment income from dividends, interest, stock, and capital gains, but your modified adjusted gross income only goes over the threshold by $15,000. So once again, single person, the threshold is $200,000. You made $215,000. Therefore, you've gone $15,000 over that threshold. Once again, you're gonna owe the 3.8% in tax, but on what amount? Since the $15,000 of income you made over $200,000 is less than the $30,000 of net investment income tax, you'll pay the 3.8% tax, but on the $15,000. So your additional tax would be $570. That is the $15,000 times 3.8%. As you can see, this tax can be a bit tricky. It's not just how much net investment income you made, but it's also how much you made from other sources and how much total you went above that threshold. Again, this is why tax planning is so important. And as you go throughout the year making this income and determining how much of an impact NIIT will have on your ultimate tax liability is super important. You don't want that surprise $1,000, $2,000, $5,000 bill. We hope you enjoyed this latest installment of What Is That? Hit the like button and subscribe to our YouTube channel. Follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.